Welcome back to another episode of Wilkin and Gutton Plans, the Balance Sheet Breakdown. Today, on the Balance Sheet Breakdown, we're going to be talking about sales tax. So back for a second month in a row, we have two of our in-firms experts on state and local tax issues, Meg Chesley and Jenna Sanfilippo. First, thanks you guys for joining us second month in a row here. Last month we talked quite a bit about what it meant when employees changed locations and started working more remotely in different states. And today I think is something that a lot more businesses and people are going to be able to relate to a little more closely.
Mm-hmm. Yeah, we're happy to be back. Thanks for having us again.
Yeah, thanks.
And so when I think about sales tax, right? When I started in public accounting, like sales tax, yeah, it was an obligation, but it didn't seem to be as big of a hot button issue as it is today. And so, the kind of first question is that just me, or did something really change? Like what happened?
No, it's not just you, Chris. It absolutely has changed since you first started in public accounting. It's also changed since I first started in public accounding, but I'm pretty sure
probably
Jenna.
not for Jenna, right?
I was going to say, I'm pretty sure Jenna is pretty much post-Wayfair.
Yeah,
so,
consistent.
June 2018 was a huge landmark sales tax case. It was South Dakota versus Wayfair. So ever since then, the landscape for sales tax has completely changed. Prior to this sales tax case, sales tax nexus was determined solely based on physical presence.
And so let's stop you there. What is nexus?
So nexus is the connection between a business and a state and local taxing jurisdiction when they have sufficient enough connection to that state for tax obligations.
Right. And so Meg, you said physical presence, right? So the old rule was if you were physically present.
Exactly. So I think number one thing we think of when we think of physical presence is the brick and mortar locations, the storefronts. But you could also have physical presence with different employee activities, property, performance of services, trade show attendance, things like that. So again, this is pre-2018, pre-Wayfair decision.
And those rules were based on before the internet, right?
Exactly.
That was from, what was the one before that? Quill, right?
Yep.
Which is from the 30s. So it's hey, it makes sense to me. In the 30s, how is your physical presence determined? Well, if I'm selling something in your state, right? And so obviously 2018 was kind of that tipping point, right? To say the internet's a thing, right? It's been around for 20 years by then, and now there are states saying, hey, the old rules of physical presence no longer apply the way they did.
No,
Exactly.
and the main reason for that is there was a significant disadvantage between the brick and mortar and the mom and pop shops, the retailers, and the online retailers, because the online retailers pre-Wayfair weren't responsible for collecting and remitting sales tax. So the cost they were charging for a similar, maybe even the same product as the brick and mortar retailer was much lower. And for that reason, there was a huge disparity between the brick and mortar and the online retailers. So the states come in, not only do they want a piece of the pie, but this is really leveling the playing field for the in-state businesses and the out-of-state retailers, the online retailers.
Right, and to me, I when I started, that like use tax was always a big thing, right? Like everybody has to file their use tax returns because of that exact situation, right? Because the obligation to pay the sales tax, even under the old rules, didn't not exist, right? It just shifted the burden, and like nothing for nothing, the average person buying, something off of the internet is not going to submit their 7% to the state.
Exactly.
Right? And so is there a difference between sales tax and a use tax?
Yeah, so there definitely is a difference. So sales tax is a consumption tax that's imposed on the sale of any goods or services. So for example, Chris, let's say you brought your family out to dinner. You're going to be charged sales tax on that bill that you're paying to the restaurant that you're going to. Whereas use tax is a complementary tax to sales tax. So it's a tax that's imposed on the use, storage, or consumption of a product or service. So let's say, for example, WG buys goods from an online retailer. They have no nexus in the state of New Jersey.
Yep.
They're not going to be charging any sales tax on the invoice to WG. However, WG is then responsible to assess and remit use tax on that invoice and remit that to the state of New Jersey.
It was consumed here in New Jersey.
Correct.
So you buy it in Pennsylvania and you don't pay tax, you drive it across the state line, and all of a sudden the obligation exists.
Yep. Definitely. Yep.
To me, that's maybe the sales tax world that I grew up with, right? If we're doing audit test work, we're looking at purchases by our clients, and if the vendor's not collecting sales tax, we're saying, hey, you might have a use tax obligation. States are coming in, and they always used to audit, right? And so, Meg, like you mentioned, Wayfair kind of totally flipped that on its head, and so it's not physical presence anymore. So what is it?
Well, before we go to what it also is, it is important to note physical presence will still establish sales tax nexus. However, it's not the only thing that will establish sales tax nexus.
It's not like the old rules are totally
abandoned.
It's
definitely not.
All those are still true. Like physical presence, if you've got your brick and mortar, you're paying sales tax the same way you've always used to. Oh, but by the way, here's this add-on for online retailers.
Exactly.
Okay.
And it's kind of like, I like to kind of describe it as like a first come, first serve basis. So it's either you have physical presence in a state or you have what's called economic nexus, which is what came out of the Wayfair case. So whichever one you hit first, and we'll dive a little bit deeper into economic nexus and the details of that, but whichever one is triggered first is what's going to establish that connection to the state the tax filing obligations. So when it comes to economic nexus, so this is what came out of the whole Wayfair case. And it essentially stated that nexus can be created based on a business's sales to a state, even though there is no physical presence within that state. And economic nexus is determined between two types of thresholds. There's a sales threshold, which is like a dollar amount of sales, and also a transactions threshold, which is a number of sales transactions to a state. And kind of similar to, no state is the same, no matter when it comes to, especially with taxes, no state is ever going to be the same with their guidance or anything. And that holds true here. No state has the same threshold as another. In most cases, there are some that followed the multi-state tax commission's set threshold and some that steered away from that. So just to kind of give two separate examples of states that differ, New Jersey, they're going to determine economic nexus based on $100,000 of sales or 200 transactions. So again, first come, first serve. In this case, whichever one you're hitting first, that's going to trigger nexus in the state. So let's say, for example, we're selling pencils. They're very low cost, but you can sell a ton of pencils.
Right.
So
it's 20 boxes of pencils might cost you $500, and all of a sudden.
So while it may take you longer to reach that dollar sales threshold, you may hit that transactions threshold really quickly. On the other side, there's artwork, very expensive. You can sell one piece of artwork, and that's very low transaction, but you could sell it for over $100,000 and hit that economic nexus threshold.
And now you've got the obligation.
Exactly. And then just kind of a differing state, California, their economic thresholds are based on $500,000 worth of sales. So I want to really emphasize the fact that you need to be aware of what the thresholds are for each state.
That's really different, and I feel like your pencils to artwork comparison like really holds true, right? I mean, if you're selling a really small dollar item, hey, it might take you years to get to the sales volumes in California. It might be thousands of transactions, but you could be grossing less than $10,000 here in New Jersey, and all of a sudden, they want to know about you.
Exactly. And another thing that's important to note that recently, it was back this last October, we saw that a lot of states are starting to shed that transaction threshold. So again, emphasis on know what the state's thresholds are, but don't rely on that. Whatever the threshold is today doesn't mean 3 or 4 months from now it's going to be the same threshold.
Which is super important, right? I mean, if I'm a new online retailer, the product I'm selling is subject to sales tax. Hey, I've got my cheat sheet here on my desk to know when I hit my 200th transaction in New Jersey, I've got to start paying. But Jenna, to your point, call me at December and it might just be 100,000 flat.
Yeah, it's very easy to fall into a habit and not really keep, because even once you start, collecting and remitting to a state doesn't mean that threshold might change, and
it's up for revaluation. Right. What you've got to do. I mean, and so one thing I always struggle with sales tax is, sure, right now the states have different thresholds for when you have the obligation. States also have different rules for what is or isn't subject to sales tax, which to me is like the bigger headache, right? Because I feel so confident about what's subject to sales tax here in New Jersey. not the case everywhere.
No.
Generally speaking, are there any like broad brush strokes to say, hey, if you're selling, most states charge sales tax on food out at restaurants, right? Like, but almost all states that have sales tax charge it on the purchase of new vehicles, right? But what do some of those rules maybe look like?
Yeah, so typically tangible personal property, so a physical product that you're selling to someone, so let's say the food that you're eating at your restaurant, that's typically taxable unless a state is specifically exempting that from its guidance. So something that's taxable in honestly most states that I've seen is alcohol or alcoholic beverages is going to be taxable. And probably maybe almost 3 everywhere. States don't tax it. Whereas something that's tax exempt, New Jersey specifically tax exempt purchase of clothing. So, or another state might tax that.
Whereas if you just go directly north, our neighbors in New York tax on clothing.
Exactly. And then when it comes to, the other end of it where we have services and intangibles, those are typically tax exempt unless specifically included in the state's guidance. So one thing that is taxable as a service is software as a service, also known as SaaS. And we kind of want to emphasize that because it's an ever-evolving topic. A lot of states are kind of currently deciding what their guidance is going to look like with that. So similar to, thresholds and anything else when it comes to states, you want to make sure you're constantly updating your research because just because it's not taxable in a state today doesn't mean it's not going to be taxable in the state tomorrow.
Well, and I feel like SaaS is one that it doesn't take much to like get over that 200 transaction threshold. Right? If I'm selling a piece of software that gives you access to live market data, right? And you pay a subscription fee every month, right? It's a SaaS. It's not a license. To get 200 customers in the state of New Jersey doesn't seem like a big ask when there's how many millions of people here, right? So like to me that's really tricky, right? Because it's hey, I've wrote and developed my software in Florida. It's up for download on the App Store or on my website, wherever it may be. All of a sudden, all these people are grabbing it from my website, and man, before I know it, I'm over the limit, right? And the way that most of the states feel is, hey, if you didn't collect and remit it, that's not the people who bought your product's problem; it's your problem, right? So, New Jersey's going to go after that technology company and say, hey, you owe us, what's the current rate, 6.25%, and that's coming out of my pocket. To me, the big take home is really about those thresholds and understanding. I think, Jenna, you mentioning SaaS is one that I know I talk all the time to new and budding SaaS companies about because it's hey, my downloads are $8 a piece. What do you mean? I have $1,600 of sales in the state of New Jersey. I've got a sales tax obligation? It's like, listen, don't shoot the messenger, right? It's not my rules. I mean, and certainly the cost of compliance is important. And then, thinking about it, right, there's what happens if I don't know this and, they talk to bright folks like yourself and say, hey, yep, you have more than 200 transactions. You should have been filing sales tax for years. Now what?
In the event that you've been above the economic nexus threshold in a state, or maybe you've had a physical presence in a state for the past few years, you should have been collecting and remitting sales tax, and you haven't been. There's a few different remedies. The main one that we encourage our clients to do, especially when it's been the past few years of activity that they haven't been reporting, is what's called a voluntary disclosure agreement, a VDA. So the beauty of a VDA is you're voluntarily going to the state and saying, I realize I should have been doing something. I wasn't doing it. I'm coming forward before you find me. And in return for me coming forward to you and volunteering myself to you, you are going to limit your look back, and it's usually a 3 or 4 year look back that they're going to look at the sales tax that should have been collected. And another benefit of a VDA is that typically penalties on the failure to file and the failure to pay, or in this case it would be late filing and late payment, is going to be abated. And the reason why that's so significant is if your sales tax liability is significant, that amount is going to be upwards of 25% of your tax liability.
Over and above what you
over and above what the actual sales tax liability is what your penalties would have been had the state found you on their own.
Yep.
But if you volunteer yourself to this program, those penalties are typically abated. In many situations, the interest on the sales tax liability is unfortunately statutory, so can't have that abated. However, I have seen some states, I believe it's Texas, who also abates interest, which is another huge benefit of this program, particularly in Texas.
Yes. I feel like the big thing there, right, is, you are voluntarily disclosing to the state that you had an obligation that you did not meet. You are not getting a letter from the state saying, hey, we think you have an obligation, and saying, oh, yep, you're right. It's really about, maybe it's late proactivity, but it's some level of proactivity. Obviously, that's not the ideal.
Right. It's not the ideal situation, but it is definitely the preferred outcome if you know you've done something wrong.
Exactly.
Because we mentioned the limited look back. If the state were to find you on their own without you voluntarily going into this program, since you hadn't already filed a tax return, there is no statute of limitations. They can look back as many years as they want at all of your sales to that particular state, and chances are your sales tax liability, your penalties and interest are going to be significantly higher than they would have been if you were to just volunteer yourself to this program.
If you just presented it. And how does that look back period, right? Say I may be just an uninformed business owner, right? And so we'll keep picking on Jenna, your license to assess, only because I feel like that's a little gray, which if I've been filing returns and claiming that I don't have taxable sales, would something like that start the look back period? Like what does it take to say, hey, I'm making the assessment, I'm making an honest assessment if I have such an obligation. I've determined, maybe with the help of my professionals, that I don't, so here's me filing zeros. If the state comes in 3, 4, 5, 6 years down the road and looks and says, oh, hey, you might not have realized, but we changed the rules. Like in New Jersey, there's a difference between prepared food and unprepared food. Hey, you're on the wrong side of the obligation. What does trying to be in compliance do, if anything, for you in those cases?
So in that situation, in the event of an audit, they would only be able to look back to their statute of limitations. Typically, a state statute of limitations is either 3 or 4 years. So they would only be able to look back to those periods and then attempt to correctly assess what the sales tax liability should have been had you been properly informed as to the sales tax implications.
Right. And I mean, to me, I feel like that's maybe another example of saying, I'm trying my best to be above board, right? It's like the number one situation is just file it right from the get-go.
Absolutely.
Never have any problems. To me, like number two is, I've been filing from the get-go, maybe not perfectly. And then when the state comes in, they have a certain look-back period, but there's opportunities similar to the VDA, right, to not pay all those interest and penalties. And then the third is like the VDA and, hey, I had this obligation, I didn't know about it until today, but here's all the money I owe you, here's all the returns I should have filed, please just accept the 3 years and let's just move forward.
Right.
Option 4 is like...
It's not as pretty.
It's not as pretty, right?
No,
It's when the state calls you and says, hey, I've bought your clothing in my state, or I've bought your widget in my state. You didn't collect sales tax, and I think you probably should have.
Right. And that's where it's problematic, because we keep talking about the statute of limitations. Since the statute of limitations have not started because you never filed that initial return, even with a zero filing, they can look back to your first sale. And even if it's 20 years ago, they're going to assess tax from that first sale, or maybe the first time you had a physical presence in the state. Whatever nexus threshold you crossed, they're going to go back to that day one.
And to me, what's super painful is like, this is not an entity level tax, right? You're supposed to just be collecting and remitting. It shouldn't cost you a penny. And now all of a sudden you got to pay the tax, you got to pay interest, maybe penalties.
Right. And it's not actually exactly a business expense.
Whereas for something that shouldn't have costed you a penny.
It should be money in, money out, and now you're paying out of pocket and then some for
right, because that is important to note, that this is it's an end user tax. So it's something that a business is required to collect and remit on behalf of their customers. And it's a trust tax that they're required to collect from their customers and then directly remit to the state. They can't hold it for any period of time.
Right. Which to me like makes this maybe more than, if you're delinquent on income taxes, well, that's your obligation anyway. Sales tax shouldn't be your obligation. So it's like to me that this is like the extra painful one.
You're more so just kind of like the carrier at that point
Right.
on behalf of the state versus, like coming directly from that end user.
Yep. I feel like that's maybe a really good synopsis for where we are, right? This truly is not intended to be an obligation of our clients, of businesses. As you guys kind of described, the rules have changed. States are becoming more aggressive. And not only that, the rules are still changing, right? The fact that those thresholds are changing all the time. Just because you didn't have an obligation last year doesn't mean you don't have an obligation this year. Doesn't mean you'll have an obligation next year. And so, that kind of vigilance and saying, hey, if the rules changed a year or two ago and I didn't know about it, now's the time to get that in and get that corrected, because it makes the sting as palatable as possible. And as those transactions are happening within those states in the future, you can collect and remit, and the right person can be satisfying their sales tax obligation, as opposed to these businesses losing between 6, 7, 9% off the top.
Right.
So this was really great. I feel like this is a subject that a lot of people can really relate to, both from the purchaser side and also the business side, right? I mean, there's a lot of small businesses that find themselves having the obligation to collect and remit. And so, certainly thank you both for the information. I think this was a really worthwhile conversation.
Yeah, thanks for having us again.
Yeah, thanks, Chris.
Absolutely. And so this brings us to an end of another episode of Wilken & Gutton Plan's Balance Sheet Breakdown. I'm Chris Frederick, where we help you make sense of the numbers.